So all of these countries are finding ways to settle outside the dollar, which was the world reserve currency. Well, how do we get people, A, to take our bonds, which still have the liquidity that nothing else does, and how do we reshore manufacturing at high interest rates? There's no way to, and a strong dollar. You can't. You devalue the dollar, you peg the back end at gold, which has zero interest rates, you bring back manufacturing, you devalue the hell out of the dollar and inflate the hell out of it to pay off the mountain of debt that you have no chance of paying off any other way without blowing up the system, and you hope to God.
The fact of the matter is that stablecoins are extremely profitable as far as the banks are concerned, because as Andy points out, what does the bank pay on a stablecoin? Zero interest. What do they receive on the, as it crosses the balance sheet into the asset side? They receive T-bills, probably no longer than, it shouldn't be longer than about 28 days, because it's meant to be cash against cash. So 28 days gives you what, at the moment, 4.3%, something like that? What's not to like?
So the act of devaluing the dollar and revaluing gold so that, as Judy says, you can peg the back end of the curve to gold. What does that mean? That means zero interest rates. So the back end, you put a zero coupon bond redeemable in gold. The more stupid we are with monetary policy and the more irresponsible we are with fiscal responsibility, the higher the price of gold goes. It acts as the interest rate. It acts as the inflation hedge. You can't put 8-10% interest rates on the long end of the bond, or stocks, bonds, real estate, the stock market, and the banks and the insurance companies go boom, just like that. You saw what happened when the long end went above 5%. The banks started to die. Put them at 8 or 9%. The real measure of inflation is so much higher than the BS, the BLS tells us. Look at the revisions on their unemployment the other day, where they said, yeah, the 300,000 or 400,000 jobs we said were created, it's only about 70,000. So they continue to disappoint us and lie to us about the CPI, where you talk about things like food, energy, and housing aren't in there, or the hedonics where they change it if steak is too expensive. We're not trusted anymore. None of this stuff works, right?
The U.S. dollar's strength has long been the backbone of global trade, but cracks are widening. Every misstep in monetary policy, every wave of debt issuance pushes gold prices higher. Central banks, particularly in China and Russia, have been aggressively accumulating gold, signaling a shift away from dollar reliance. Meanwhile, real inflation appears far higher than official numbers suggest, eroding trust in economic reporting. This loss of credibility makes alternative systems more appealing. If the dollar continues to weaken, gold could once again become the cornerstone of value, a direct challenge to America's financial dominance.
So, you peg the back end of the bond market, redeemability in gold, and you devalue the dollar. What does that enable us to do? Well, that enables us to bring home our manufacturing at zero interest rates and reestablish our manufacturing base with a very weak dollar and low interest rates allows us to sell our goods to the rest of the world. We already see through BRICS Pay and BRICS Bridge, all of these countries that are joined together with the BRICS their whole idea is a common settlement system outside the dollar. It's not a common BRICS currency. BRICS Bridge has already been connected to 11 Asian countries and 5 Middle Eastern countries, which is 38% of global GDP. And guess what just came out of Forbes magazine the other day? Those Asian countries, the countries in Southeast Asia that you know so well, Jesse, are now China's largest trading partner by far, 3 times what the United States is. And they're connected to BRICS Bridge, which settles in 7 seconds outside of SWIFT purview, can't be messed with by the SWIFT at a 98% reduction in fees. And we're now integrating it into the Belt Road Initiative, which is 75% of human population. It's not a common currency, it's a common settlement currency.
One argument for dollar devaluation is rooted in industrial revival. A weaker dollar lowers export costs, encouraging the return of U.S. manufacturing. Zero interest rates on gold-backed bonds could provide cheap financing to rebuild factories and supply chains. Yet this strategy comes with risks. It relies on inflation to erode existing debt. Critics warn it could devastate savings and trigger further instability. Still, history shows that when pressured, the U.S. MAC often reinvents itself. The question remains, can this approach reboot America's economic engine, Or is it simply a desperate Hail Mary in the face of unsustainable debt?
So all of these countries are finding ways to settle outside the dollar, which was the world reserve currency. Well, how do we get people, A, to take our bonds, which still have the liquidity that nothing else does, and how do we reshore manufacturing at high interest rates? There's no way to, and a strong dollar. You can't. You devalue the dollar, you peg the back end at gold, which has zero interest rates, you bring back manufacturing, you devalue the hell out of the dollar and inflict the hell out of it to pay off the mountain of debt that you have no chance of paying off any other way without blowing up the system. And you hope to God that by bringing back the manufacturing, we are the engine of ingenuity. And when our backs are against the wall, the United States has done, I think, its best work. Go back through history and you'll see that. So in my mind, it's a Hail Mary. In my mind, there is no way to bring back manufacturing without destroying the entire system because of the interest rates. They have to go higher for people to take our debt because we're not trusted and we keep spending like drunken sailors. So if Judy is right, and they do peg the back end of the market to the bond market, to gold, to keep rates at zero, to bring back manufacturing, to sell our goods to the rest of the world.
While the U.S. debates monetary experiments, the BRICS alliance is building alternatives. Through the BRICS Bridge settlement system, trade now bypasses SWIFT, settling transactions in seconds with minimal fees. By 2025, more than a dozen Asian and Middle Eastern nations, representing nearly 40% of global GDP, are participating. This is not a single currency, but a shared financial infrastructure designed to reduce dollar dependence. China, already Southeast Asia's largest trading partner, has leveraged this system to expand its influence. For Washington, the rise of these networks signals a dangerous erosion of the dollar's role as the world's reserve currency.
I think she's onto something because the stablecoin bill is the last piece of the puzzle, which runs the government on the very short end of the treasury. All of that liquidity is now, it's all synthetic, right? So hopefully this would work. I don't know how else that you bring back manufacturing, because if we don't, we're done. Ultimately, the next generation is dead in the water, in my opinion, when you have the wealthy at the top who are in financial services and in tech, and the rest of the country, 60% who doesn't have college education, and we don't make anything anymore. You're talking bad situation. So if there is any nobility in all of the things that Trump is trying to do, if he really is trying to bring back manufacturing, I don't know any other way to do this than what Judy is talking about, and the last piece being the stablecoin bill, which runs the front end. I think it's a shot. So yes, I do think they'll revalue gold higher than most people think possible. But what they're really doing by doing that is devaluing the dollar. And hey, you can't make it up. It's called the gold revaluation account. It's happened 3 times before. Why not do it again? So with all due respect to someone who I think is the smartest guy in this industry, I'll just take a different viewpoint. Who's to say I'm right? I don't know, but it makes sense to me.
In parallel, stablecoins are reshaping finance from within. U.S. banks increasingly back digital tokens with short-term treasury bills, earning yields while paying nothing on deposits. This has quietly become one of the most profitable corners of finance, aligning the interests of regulators, banks, and the Treasury. The proposed Stablecoin Act could formalize this system, anchoring short-term liquidity in government debt. But skeptics warn of hidden risks: over-reliance on digital money, a fragile crypto ecosystem, and the possibility of cascading failures when credit tightens. What appears to be innovation may in fact be another layer of systemic fragility.
The fact of the matter is that stablecoins are extremely profitable as far as the banks are concerned, because, as Andy points out, what do you pay on? What does the bank pay on a stablecoin? Zero interest. What do they receive on the, as it crosses the balance sheet into the asset side? They receive T-bills, probably no longer than, it shouldn't be longer than about 28 days, because it's meant to be cash against cash. So 28 days gives you what, at the moment, 4.3%, something like that? What's not to like? And I think this probably came about very much with the agreement, if not maybe a little bit of background lobbying by US banks. who kind of like this stuff and at the moment are basically frightened of risk. I mean, I'm sure their lending officers are sort of seeing, stuff coming in that really worries them about extending credit to business and so on and so forth. This, if you like, is a reverse deal in the sense that it's, banks issuing stable coins. They're effectively acting rather like the old-fashioned deposit banks, which have always eventually failed or gone into credit creation. Of course, as far as the US Treasury is concerned, I think, as Andy points out, anything to help buying of US government debt. And so it fits in very, very well with that. Now, having said that, I think the idea that stablecoins will expand more rapidly than the crypto market, I think are ill-founded. I don't see that at all. I also think the real danger in this is that the crypto market is basically a scam. I mean, we love the ideas of blockchains and the possibilities and all the rest of it, but
gold revaluation, dollar devaluation, stablecoins, and shifting global alliances all point to one reality. The old financial order is fracturing. Supporters of gold-backed bonds argue it may restore balance, while critics see it as a desperate gamble. If the U.S. fails to restore trust, its debt burden and loss of industrial power could doom future generations. Yet history shows America often thrives under pressure. Whether this strategy succeeds or fails will determine if the U.S. can remain an economic powerhouse or if the world decisively pivots toward new centers of power in Asia and beyond.
When you see who actually owns Bitcoin, who actually is dealing in it, who actually is ramping it, which is really what's been happening, I mean, it's full of crooks, basically, and Ponzi scheme merchants. So, I think once the credit bubble bursts, which, again, I'm sure is a topic which we'll get into, then leading the pop bang, the implosion is going to be cryptocurrencies. And then, of course, we ask ourselves about, was this Genius Act such a good thing? Is it ever going to produce anything, et cetera, et cetera? So that would be my take on it. I think the banks wanted it because they see this as being an extremely profitable thing. I don't think it's the big banks. I think it's, the sort of, a few tiers down maybe. I think as far as the regulators are concerned, they just want to bring this into their tent so they can have some control over it. Other than that, I think nothing to see, move along.